Adjusting entries for depreciation expense. Depreciation is a way of matching an asset's cost against the income it helps to produce over time. To depreciate an asset, you must first determine its depreciable base, which is simply its original cost less its residual value, the estimated value that the asset will have when it can no longer be used. For example, assume that a machine costs $110,000, has a residual value of $10,000, and an estimated life of 5 years. Under the simplest method of depreciation, the straight-line method, the company may take $20,000 depreciation expense in each of the 5 years. $110,000 cost minus $10,000 residual value equals $100,000 divided by 5 years equals $20,000 per year. To be depreciable, assets must meet the following conditions. The asset must be tangible property, such as a building, equipment, or furniture. Land is not depreciable, and the asset cannot be held for resale, such as inventory, or for investment purposes, such as common stock. And the asset must have a useful life of more than 1 year when acquired. The journal entry to record depreciation at year end is debit depreciation expense, credit accumulated depreciation to record depreciation expense. At the beginning of 2019, Hilltop purchases equipment at a cost of $5,000. Residual value is estimated at $200, and its useful life is estimated at 4 years. If Hilltop uses straight-line depreciation, what is its annual depreciation expense? Hilltop's annual depreciation expense is computed as follows. $5,000 cost minus $200 equals $4,800 depreciable base. $4,800 depreciable base divided by 4 years equals $1,200 depreciation expense per year. The adjusting journal entry at year end is recorded as follows. Debit depreciation expense $1,200, credit accumulated depreciation, equipment, $1,200 to record depreciation expense. At the beginning of 2019, Hilltop buys property for $300,000, including land at $140,000. Land cannot be depreciated, and a building at $160,000. The building has an estimated residual value of $10,000 and an estimated life of 30 years. If Hilltop depreciates the building under the straight-line method, what is its annual depreciation expense? Hilltop's annual depreciation expense is computed as follows. $160,000 minus $10,000 equals $150,000 depreciable base. $150,000 depreciable base divided by 30 years equals $5,000 depreciation expense per year. The adjusting journal entry at year end is recorded as follows. Debit depreciation expense $5,000. Credit accumulated depreciation, building, $5,000 to record depreciation expense. Hilltop records this journal entry at the end of each year for 30 years. In practice, however, Hilltop would use a single adjusting journal entry for all of its depreciable assets. The single adjusting journal entry at year end is recorded as follows. Debit depreciation expense $6,200. Credit accumulated depreciation equipment $1,200. Credit accumulated depreciation building $5,000 to record depreciation expense. Depreciation expense is an expense on the income statement. Total assets and total accumulated depreciation amounts appear on the balance sheet. The accumulated depreciation account, that is, the total expense taken over the years, reduces the book value of the asset. Combining the data from examples 1 and 2, these accounts will appear on Hilltop's 2019 balance sheet as follows. Property, plant, and equipment. Land at cost, $140,000. Buildings at cost, $160,000. less accumulated depreciation, $5,000 equals $155,000. Equipment at cost, $5,000 less accumulated depreciation, $1,200 equals $3,800. Total property, plant, and equipment, $298,800. Each year, the balance in Hilltop's accumulated depreciation account will increase as another year of depreciation expense is added for each depreciable asset. The book value of Hilltop's total property, plant, and equipment will decrease. In reality, depreciation expense for all depreciable asset is computed, then recorded on the depreciation schedule. The year-end adjustment is then copied onto the trial balance, and the adjusting entry is recorded in the general journal. A piece of equipment costs $20,000. The estimated residual value is $2,000, and it is estimated to have a 4-year life. If the company uses straight-line depreciation, then depreciation expense for years 1 and 2, respectively, will be A. $4,500 and $4,500. B. $5,000 and $5,000. C. $4,500 and $5,000. D. $5,000 and $4,500. A. $4,500 and $4,500. $20,000 cost minus $2,000 residual value equals $18,000. Depreciable base divided by 4 years equals $4,500 per year depreciation expense over each of the 4 years of its life. A building is acquired at a cost of $400,000. It is estimated to have a 40-year life and a residual value of $40,000. If the building is depreciated under the straight-line method, annual depreciation expense will be A. $400,000, B. $40,000, C. $10,000, D. $9,000. D. $9,000. $400,000 cost minus $40,000 residual value equals $360,000 depreciable base divided by 40 years equals $9,000 depreciation expense per year.